Welcome to This Week in Local, a Localogy podcast featuring lively conversations about the local digital ecosystem, hosted by Localogy analysts Mike Bolin and Charles Laughlin.
Hello, and welcome to This Week in Local. I'm Charles Laughlin, and I'm here with Mike Bolin. Mike, how's it going?
Hi, Charlie. Going well.
Mike, why don't you tell us what you're working on?
Yeah, so we came across an interesting angle this week that I'm sort of in the process of breaking down. And it's not an official announcement, but it is sort of a leak that was uncovered by Axios that Amazon is going to start doing something interesting in sort of the SMB world, which is it's planning on sort of tapping into idle SMB resources for its sort of last mile delivery. And I'll explain what I mean by that. So it's looking at SMBs as a potential resource to sort of deliver packages, store packages, deliver packages, and sort of a lot going on there, a lot of angles. We can look at this from like the Amazon sort of angle and the SMB angle. So I'll break it down that way. So the Amazon angle is sort of logical why they're doing this in terms of just, it fits the persona. It's on brand for Amazon to do this type of experiment. They're all about trying to find these clever little ways for like logistical efficiencies, right? And this is one where it's just starting to speculate if it could just sort of alleviate some of its ongoing pervasive last mile challenges on the backs of SMBs. And it's thinking that one, it could be cost effective, and two, it could be effective, just from a execution standpoint, because a lot of these SMBs just are sort of familiar with their neighborhoods and all that. But back to the sort of cost efficiency, we can look at Amazon and just sort of speculate on some of their motivations here. They have gone through so much sort of drama politically and operationally around collective bargaining, around the sort of conditions of their fulfillment centers and their last mile drivers and all these other things. So they're looking at that as this sort of thorn in their side from a cost and operational perspective and thinking, are there other ways we could like deliver packages from, in this case, they're looking at just sort of the SMB segment as one sort of avenue to do that. I think there also might be some PR drivers. So I've been saying there are HR drivers and PR drivers. The HR drivers are the how they're employing these folks and if they can just find cheaper ways. But the PR angle, Amazon, as we know, has really gotten flack for its like entire existence for the sort of scale and pricing, aggressive pricing that has been a detriment to the world of SMBs. And perhaps it sees this as sort of a PR move to sort of, give back by, supplying them with supplemental income. I'm not sure if that's an actual driver or one that I'm speculating, but a few ways this makes sense for them. Now, moving on to the SMB angle, I think that's a bit more nuanced. And I think raises a lot of sort of practical challenges that could make this whole thing fall on its face. So, first of all, going back to the point I just made, a lot of SMBs sort of see Amazon as like the Antichrist. So will they be comfortable getting into bed with the enemy, sleeping with the enemy, however you want to put it? And a lot of this will come down to what the actual fees are that they're, or the compensation, I guess I should call it, that Amazon's offering. If we know Amazon, it usually squeezes margins into oblivion. So I have to assume that like the payment's not going to be that great. And I think that when you're looking at SMBs, this whole thing sort of makes sense on paper maybe, but the way we know SMBs is a little bit more nuanced, where there is really no like consistent behavior. The market is so fragmented, and that's one of the challenges, Charlie, you and I have been like studying for years in terms of like why it's a challenge to sort of address it from a sales and product perspective. For the same reason, there aren't really consistent behavior or outcomes that can be predicted. So if Amazon is sort of resting on this sort of persona to do something that is an important part of its business, which is to deliver things on time, it just doesn't seem that like SMBs and their schedules and the differences and putting out fires and the differences of a Tuesday to a Wednesday to a Thursday, that like they can be counted on to like deliver packages reliably. I just don't see that happening. Beyond sort of time availability is space availability. I mean, if you think about businesses like restaurants, they have every last square inch sort of taken in terms of just yield optimization and having enough tabletops for their, busiest hours and stuff like that. I think that, it just comes down to some of these practical things. And even if Amazon is able to sort of alleviate some of these common SMB challenges, are they going to pay enough to make it worthwhile for SMBs? And I think that has yet to be seen. So we're gonna watch this. I'm very skeptical for all the reasons I just mentioned. The Axios reporting has indicated that they're going to sort of test this in a number of sort of like smaller tier 2 cities, like Columbia, Missouri, and Fayetteville, Arkansas.
Right.
And interestingly,
I'm sorry to those towns.
Yeah, that's probably tier 3. Yeah, I've said tier 2. But interestingly, they also on that list is that they're going to do it in Manhattan to, I assume, ultimately stress test it.
Give it a little tier 1 magic.
Yeah, right. Like the space constraint issues that I mentioned. If they really want to stress test it, they're going to do it there and then in these smaller cities and just see what they find out. But so we're going to have to watch to see what happens there. But consider me skeptical.
I will join you in that skepticism from what I've heard, from what you've just described. One of the things that popped in my head as you were saying that SMBs think of Amazon as the enemy, and I don't disagree with that, but I'm wondering, there's a segmentation to who hates Amazon the most, right? Bookstores, small independent small town bookstores truly hate Amazon, I would imagine. Whereas I imagine the local plumber probably doesn't think twice about Amazon. So I guess, is there a sort of a matrix of who makes it for a good partner in this scenario versus who hates Amazon the most? Like the plumber with a little spare room in the back of the truck next to the tools. I'm not sure I want him delivering my package. That said, he's probably not going to have an axe to grind necessarily against Amazon, whereas the bookstore will, but the bookstore doesn't really deliver books to people, I don't think. So I don't know, that's one way to think about it. Are the people most likely to benefit from this? Are the people most likely to have a positive view of Amazon? I don't know.
Yeah. Well, the cleanliness and the hygiene of the plumber's tools.
Yeah, set that aside for a moment.
Truck is one thing.
Yeah.
But yeah, you're right. It comes down to the sort of bisection of service-based businesses versus like consumer products. And that's obviously where Amazon does or does not impede. Right. So yeah, and not only that, it's conducive to anyone that has a truck that does business outside of, if they're visiting homes, if they are delivering things, if they're already inclined to be doing that. And this is sort of like an easy way to monetize sunk costs, like the gas they're already paying for, or like you said, the space in the truck that they've already bought. It does make sense. So I think it's a matter of finding a critical mass of those types of businesses.
All right. That's really interesting, Mike. So I don't just want to talk about something I talk about too much, which is kind of the payment space and buy now, pay later. There's been a couple of interesting things floating around lately that I just wanted to bring up. I don't know if they're necessarily tied together all that well, but they were kind of interesting things that I've read or come across. The first biggest one was PayPal, sort of the OG of payments, digital payments, has done something interesting, and it's sold up to 40 billion euros, which is about $43 billion, I think, in current currency exchange, to KKR, the big private equity, powerhouse, basically selling their debt to KKR, a European buy now, pay later debt, to be clear. And the stuff I read about this and, the videos I've watched about this sort of positioned it as KKR kind of competing with banks for these big, debt purchases, to get into the consumer credit space with what they consider a fairly low risk portfolio of short-term loans. And even though I've been tough on buy now, pay later for a number of reasons, one of which is that it's, the default rates have been rising and, contributing to the debt bubble and attracting regulatory attention and doing weird things like gas now, pay later, like using buy now, pay later to pay for a tank of gas, stuff I considered, I don't know, not great, So I've kind of been tough on them for a number of things, but overall, kind of the quality of these loans from our credit perspective isn't bad. I mean, the default rates are still really low. I know we had Mike Cohen from Square Block, et cetera, the big payments company, they're in BNPL through their acquisition of Afterpay. He said their default rates were, around 1% or something like that. So, all in all, it's still a pretty decent block of debt to buy that, but the question I have that I haven't really seen a good answer to or any good analysis around yet, why did PayPal sell it? Are they, there's no indication that they're getting out of buy now, pay later. From what I read, they processed $20 billion worth of, gross volume of buy now, pay later loans last year. That's big business, and that's a lot of, value delivered to merchants and other things. And, they, I'm sure, could make quite a bit of money off of that. And so why sell the debt? I don't know what signal that says. That's one thing. The other thing I read, and I've been sort of following, this whole thing that happened with the Supreme Court last week with, student debt, student loan repayments, the knocking down Biden's plan. Even before that happened, there was a pending resumption of payments for certain debt holders who had kind of gotten an abatement because of COVID and all this other stuff. That may become a bigger issue with what's the Supreme Court decided. There was an argument that that's going to crowd out repayments on buy now, pay later, and it might be a real drag on BNPL, sort of post-October when all this stuff starts to happen again. So it's interesting signals, but what's kind of overhanging all of this is that Affirm, which is kind of the bellwether buy now, pay later stock, has had a great year. They opened the year around $9.10. Most recent close was $15.42. So the mixed signals are crazy in buy now, pay later between regulators wanting to regulate it as credit and people complaining about it, creating this debt bubble. On the other hand, everyone seems to want in, to make money on this thing.
Yeah.
So I don't know what's going on, but it looks like it's going to be frothy as hell in the buy now, pay later space going forward. So it's going to be fun to watch.
Mm-hmm. So it's interesting. We always look at market demand signals and what the market will bear. And this is at once a confident signal for BNPL debt, because someone bought it, but it's also sort of a negative confidence signal if we look at the fact that PayPal's retreating and just sort of speculating PayPal's retreat could be due to sort of opportunity cost and focus, and they don't want to deal with it and just sort of retreating that line of its business. Whereas KKR buying it for opportunistic reasons, obviously they feel that there's value there. It would make sense, I think, or maybe it's the opposite. If we look at the difference in interest rates from when a lot of those sort of that debt was first sort of granted to then when it is redeemed, that could have an impact on the value of that debt.
Could be, well. Buy now, pay later companies are very interest rate sensitive because they have to take on all this debt in order to fund these loans. Yeah. And that's, as anything like that, it's interest rate sensitive. Yeah. So that may be a factor. That's more math than I want to do right now. Yeah. Right. But that may be a factor as well.
Yeah. And, it's a sort of, it could be simple as as simple as a, one man's trash type of thing.
Maybe as simple as that. And PayPal just may have wanted the cash for other reasons. I know they're going to, there's talk of them using it for some of it for a stock repurchase and other things. And
it could be more valuable to KKR in terms of just sort of synergies with other directions it's going or its existing business, which sort of makes sense.
That seemed to be what, the coverage I was looking at was saying, is that this is about KKR getting more into the consumer finance.
Yeah. Business. It's funny too, if we talk about consumer debt and companies that have gotten into it and now are possibly retreating, Goldman Sachs is doing something different in terms of it's sort of the underwriter for the Apple card and the sort of high yield savings account that's tied to it. It's now looking to find someone to basically buy its position and get it out of that commitment.
Goldman. Yeah, that makes sense. Mm-hmm. But, another signal I saw is that Amazon is adding Affirm to its Amazon Pay solution. So, like I said at the beginning of this, the signals are all over the place.
And it's a lot of just shifting around, maneuvering. It makes sense.
Yeah, who's in a strong enough position to take on this risk and who isn't? Mm-hmm. A lot of that. That's a lot of what's going on, I'm sure. Mm-hmm. Okay, Mike, why don't you tell us who won the week?
Sure. So my selection for who won the week this week is Snap, because it recently surpassed 4 million paid users for Snapchat Plus, which is its paid subscription product. In doing so, it has sort of validated this idea of this sort of looming question: will consumers pay for things? As you have ad-supported businesses like Snap is that are trying to diversify into other areas, will consumers pay for things? We've seen some validation of this concept with sort of in the publishing world. Companies like The Atlantic and the New York Times and their digital subscriptions have done quite well. Others have not. Snap has now validated this in the sort of social space, which is particularly relevant if you stack it next to Twitter Blue, which has not done as well. So it comes down to not just will people pay for things, but you need to really thoughtfully devise the sort of product set and feature set. And I think Snap has done that. If you want more information on that, we broke it down, all the sort of features and best practices on an article on Localogy Insider.
Right. I don't know, a lot to add to this. I think my sense is this is about execution and who's executing well. The conversation I want to have at some point, and I guess I have to do a little research on it first. The whole newsletter space I find really fascinating. There's been some fundraising in it recently. Beehive, I think it was, raised some money recently. And I think companies like Meta and Twitter have sort of gone in and out of having this as part of their feature set.
Yeah.
And I think this is kind of a big piece of that subscription creator revenue space, that I think we talk about, but I think there's a lot more to be said.
Now, a quick point to underscore, I should have said this in just, I sort of buried the lead here. This is a $4 a month product.
Right, not $40.
Right,
Yeah,
and it comes down to like product market fit, feature set, but also like inelastic pricing. But really the point here is we're going to quantify the actual impact to Snap's top line here. $4 a month, the annual impact there from this 4 million paid users is almost 200 million in top line revenue, incremental, for a company that brings in ad revenue around 5 billion. So it's consequential.
Yeah. So my Who Won the Week is going to be very brief. It's a little more personal than what we normally do. So I live in Highland Park, Illinois, which is going to ring a bell for a lot of people, I think. As we are talking today, Mike, it's in the middle of the holiday week, Independence Day holiday week. 1 year ago on Independence Day, in the town that I live in, I didn't happen to be at this particular event. There was a 4th of July parade. There was a mass shooting, led to several deaths, multiple, horrific injuries. Very traumatic. It was in the news. The news crews were camped out here for about a week or so. I just want to acknowledge that anniversary. Really, that's my Who Won the Week. It's not about winning or losing the week. It's really, I just want to acknowledge that anniversary. And the town that I've lived in for quite a few years is still here, still standing.
That's great.
Okay, Mike, we'll just leave that there and let you read us out.
Yeah, thanks, Charlie. Thanks, everyone, for listening. This has been This Week in Local. Stay tuned every week for more episodes. You can find the show on all major podcast networks and find out more at localogy.com. Please subscribe, like, and comment. So I'm Mike Boland with Charles Laughlin. Our producer is Dara Sweat. So thanks for listening and see you next week.
Thank you for tuning in to this week's episode of Localogy's This Week in Local with Mike Boland and Charles Laughlin. Be sure to subscribe for more.